You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from theoptionsinsider.com and co-hosts, Uncle Mike Tusaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi, and Mark the Greasy Meatball Sebastian from OptionPit.com.
All right, everybody, welcome back to the Option Block, everyone's favorite bi-weekly source for all things options related. A little bit of wit, a little bit of wisdom, a little bit of education, a little bit of analysis, throw in some unusual activity in there, and you stir it all together, and you have the heady witch's brew. That is the Option Block. My name is Mark Longo from theoptionsinsider.com, as well as from a little thing we like to call the old Options Insider Radio Network. 13 programs on said network, quite a few for you guys to choose from. And where can you find all of that listening goodness? Well, of course, theoptionsinsider.com. Just surf on over there, the flagship, the mothership. Click on the View Archives link, and then you're pretty much off to the races from there. You can download, stream till your heart's content, and of course you can find it in all the usual outlets: iTunes, Stitcher, Aha Mobile, TuneIn, even our mobile app available on the iOS, Android, and Amazon app stores. So again, no shortage of ways for you guys to listen to the show, and then of course to send us your questions, your comments, your feedback. We love to hear from you guys. And coming in off the heels of this crazy holiday weekend, we have a bit of a truncated panel this week. I know the Rock Lobster wanted to join us, but I believe he is moving actually today. So I wouldn't wish moving on my worst enemy. So enjoy your moving time, Mr. Rock Lobster. So at least for the time being, while we secure the whereabouts of Mr. Mark Sebastian, the Greasy Meatball, it will be myself and our old favorite, you know him, you love him, as Uncle Mike Tusaw from RCM Wealth Advisors, a.k.a. RCM Alternatives. Uncle Mike, welcome back to the program, sir. How was your holiday weekend?
Always a pleasure to be here, especially coming off of what my faith believes is the most important day in history. So it's very good to be here. Loving it. Having a great day. It's sunny and 85 here in beautiful, sunny, scenic St. Charles, Illinois. Not really.
I subscribe to more of the candy and mass-produced creed, so I guess that would make Valentine's Day my biggest day. So I'm past my biggest holiday.
Well, but surely you had the Easter candy too.
That's true. There is a lot of candy and mass-produced consumerism to go around on Easter weekend as well. So I was pretty happy camper on both weekends.
You'll be happy to know that our neighborhood Easter egg hunt, I typically play the Easter Bunny every year, and this year we had the fire department come out is like to have something for the kids to just do the fire truck, just to climb on the fire truck and things like that. I was actually had a special request from the local fire department to have me go out with the fire department to put on shows next year for their Easter fire truck shows. Wow. So I'm even in demand as the Easter Bunny.
Wow, I guess you put on quite a show as the Easter Bunny. Do you swallow fire in the whole 9 yards? Is it really quite the performance?
Oh, it's something else. It is amazing.
Just promise me this. Promise me that your Easter Bunny costume is not as terrifying as some of those mall Easter bunnies you see. My little guy wanted to see the Easter Bunny this year, and I was just like, I was watching the guy taking the pictures, and I was like, these bunny costumes are a little bit horrifying.
Well, it was funny. Last year, the kids were all scared of me, so I was thinking this is like my fourth or fifth year doing it, and I was planning on retiring and not doing it this year, but before the Easter Bunny, my wife actually was combing out the hair of the fur of the Easter Bunny face or whatever, and so she did a lot to it. And last year, I didn't really do anything to it. The kids were all scared of me, so I'm like, well, I'm not going to do this anymore. I don't want to scare kids. But this year, after my wife gave the Easter Bunny head a little bit of a makeover, I was like, all the kids loved me this year. No one was scared of me at all.
Well, there you go, listeners. You hear us always raving and ranting about the lovely metropolis that is St. Charles, Illinois on this program. And now you can add yet another plus to the Move to St. Charles column. That is, they have the fantastic Easter Day festivities complete with Uncle Mike Tusaw as the Easter Bunny. If that doesn't get you to book your next flight/drive/train ride to St. Charles, Illinois, then I don't know what will. And before we can scare any more children, Uncle Mike, let's dive right on into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the trading block.
All right, everybody, welcome to the trading block. You guys know the drill. This is the portion of the program where we break down what was moving, what was shaking, what was catching our eye on the street today. Bit of an upside day on the old street. I'm looking through my watch list right now, and pretty much a sea of green across the board. Most of the major indices up pretty hard on the day. S&P up about 0.75 of a percentage point or so, or about 14.5 handles to 2081. The Dow up about the same on a percentage basis to 17,888. And the Qs up even more, up nearly a full percentage point on ye old Qs. Of course, that means VIX cash taking it, actually not really taking it on, doing much of anything today, only coming in actually essentially unched on the day. So you have a day like today where the weekend coming back in seems to have offset any real decrease you're going to see out of the markets rallying. Usually on a given day, you're going to see market up about 0.75 of a percentage point. VIX cash clearly going to come off at least a wee bit, and weekend coming back in this week seems to have offset, hovering right around the 14.5, 1460 level. Well, a lot for us to parse in today's activity, Uncle Mike, but before we get into some individual highlights that caught my eye, let's start with what caught your eye in today's activity.
Oh, it felt like 2011 again. We have a dovish Fed. We have, with the threat of inflation, so to speak, somewhat because of the Fed being dovish, we have a bullish stock market, we have bonds going down, and we have some crazy stuff going on in the Middle East with OPEC saying that they're going to raise their prices. So it felt, I hate to say normal, but it almost felt like a normal day today, even though nothing's been normal for the last couple of years.
Yeah, it's kind of hard to describe anything we've been talking about of late as a normal. Everything seems to be outside of its normal, usual range. Of course, we had that employment report last week, and that really, coming out of the Bureau of Labor Statistics, brought a bit of an upbeat mood back to the labor market, at least, or brought what I used to be an upbeat labor market a little bit, perhaps more cautious now in the wake of that data, a wee bit disappointing, shall we say. But of course, that could, people who are saying right now the Fed is already dovish, well, this, of course, just adds fuel to their fire. Why would the Fed jump in and jack up rates if we're already seeing a weak labor market, a weak jobs report? So that gives people out there who are on the no change, no raise, at least anytime in the near future camp, gives those people a little bit more ammunition to their argument. We've discussed this on other shows, Uncle Mike. I'm not sure if I've ever really gotten your opinion on it. Where do you fall on the great will they, won't they debate? You think they'll actually move in 2015, or are you pretty much next year is the earliest you think at this point?
That's kind of what I'm thinking. They're eventually, I don't see how they possibly can't move at some point, but I really don't see it happening this year because they keep punting every time they meet. It seems like they just find new ways of saying, we're not going to do it now, but we might do it soon, but possibly later. And it's like they say the same thing every time, but with different words is what it feels like to me.
Certainly has that feel. We've been debating this back and forth on our other program, including the Volatility Views program. We have some outstanding wagers going there regarding will they move by June, will they move by September, will they move by 2016. I definitely am falling. I was already leaning towards 2016, and now with the data coming out over the past few weeks, and of course the Fed's, I think you can call them conservatively dovish comments coming out recently, it certainly seems to have really moved any aggressive movements to the back burner, certainly not by the June meeting. Some argument, I guess, could still be made for the September, but not unless this data really starts turning around and showing the economy is just tearing it up and they need to put the brakes on. Because that's what they're doing. They're putting the brakes on. Unless they see a need to do that. You know, why do you put the brakes on a car that is already slowing to a crawl as we speak? You know, doesn't really make much sense, does it, sir?
No, I would totally agree. And you keep mentioning data. One of the key terms that they seem to say all the time is they want to be data dependent. So yeah, I think if we just continue to have things like what we had on Friday, I would agree. I don't see anything happening anytime soon.
Speaking of cars and things that can get moving, let's move on to a name that I know a lot of you like to pay attention to, whether it's to slam it or to praise it, or perhaps a little bit of both. That is, of course, Tesla. Seems like not a week can go by without yet another press conference announcing some other development in the land of Tesla. It's been up, it's been down. Of late, we've been talking about how the stock was kind of hovering back down decently below the 200 handle, got into like the 185 or so range for a little while there. It's kind of vacillating around that level. Seems like some of the high-flying days of Tesla may be behind them, at least for the near term. Well, that, of course, changed today's move, rallying 12 handles, got as high as, I believe, a 205. Let me pull up 207 the orders, nearly 208 today. So just crazy town out there. And Tesla showing that some of their shipments for the last quarter in terms of cars were a little bit better than people expected. And that, of course, Tesla, not one to miss an opportunity to blow their own horn, did so in a very resounding fashion. Stock back over 200, as you might expect. What's kind of interesting about Tesla, Uncle Mike, though, I know you don't trade a lot of Tesla, but I'm sure you watch it, and a lot of our listeners certainly pay attention to this one. You see a day like this, I don't care what the underlying is. Throw Tesla out there. I don't care what it is. Any underlying is going to rally 6%, 12 handles in one day. You usually see an overwhelming preponderance of call buyers on these names, 3, 4, 5 to 1 calls over puts and things like that. And if you do see puts, of course, you see people blasting out on them. Pretty much becomes almost a delta play at that point. Stock's moving so hard, people just want to get in and get some exposure to that upside movement. And yet with Tesla, it seems like despite the zealots are certainly out there, and the name doing some decent volume today, it's been averaging about 106,000 contracts a day, doing about 172,000 today, so not quite 2x, but a decent bump in volume. Excuse me if you can't tell, listeners. Been traveling all last week, and somehow that cold I thought I was over somehow came back. So that's always fun when you talk for a living, but bear with me. And of course, today's volume in Tesla, not perhaps as overtly bullish as you may expect. Only about 1.3 to 1 calls over puts. Of course, we know here on the show that doesn't mean anything. Calls over puts, people can be doing a lot of different things with that. So you parse those those numbers a little bit, and you see that the actual percentage, the actual numbers of puts, for example, they were almost identical. Only about a couple of hundred contracts different, Uncle Mike, between the number of puts that were bought, lifting offers, versus the number of puts that were sold, hitting the bid, about 17,500 or so for each, which is interesting. On a day like today in Tesla, a little bit more discrepancy on the calls, people lifting offers on calls, about 24,000 versus 18,000 people hitting bids on calls. So still not as overtly bullish as you might expect. Does that surprise you, Uncle Mike, particularly for a name like Tesla that seems to be kind of like Apple was a few years ago, where the zealots are out there in force and they want to do nothing but buy upside calls? Even on a day like today, when it's moving hard to the upside, and don't mistake me, listeners, it was still net long deltas, about 250,000 deltas or so, but still, just interesting to see. There still is a bit of a dichotomy of opinion out there. Does that surprise you, Uncle Mike?
Not to tell you the truth, it does not. There's two clubs, both of which I'm one of the founding members, the Apple Zealot Club and the Gold Zealot Club. The Gold Zealot Club actually has several branches to it. There's the Gold Zealots that think that if you buy anything but physical gold, you're stupid because all the zombies are going to come at any minute and the government's going to shut you down at any second. You need to have the guns loaded and have the gold ready for the day that anarchy comes, which could be any second. There's that club. Then there's the people like me that just think that with the constant printing of money, that combined with the economic policies that are going on, that over the long term gold will be a good thing, but you need to kind of have some type of protection. That's the club that I'm in. The other club that exists is the Apple Zealot Club. I'm a member of that club as well, but I don't know that if the Tesla Zealot Club that's out there is quite as big as the Apple Zealot Club or the Gold Zealot Club. So I can't say I'm too surprised, but just in general, like even if something like GE or clubs that don't, or stocks that don't necessarily have a quote unquote Zealot Club, I don't think that I would think that there would be more upside call euphoria if something like that were to happen.
You know, it's funny that all this news come out about Tesla recently, because when I was traveling, I was chatting with someone about Tesla, and they kind of expressed a similar viewpoint that I have to their products, stock aside. A lot of people are excited that the idea of these electric cars appeal to them. They seem cool. They have a lot of cool gadgets and things. Yet people are hesitant to buy the car because they think they don't know this crazy, who knows what this company is. Is it a short selling scheme? Is it a real car company? Are they going to be around in 5 years? You see all these crazy hypotheses about Tesla out there. So I was positing to this person last week, Uncle Mike, and let me know what you think about this. I was like, well, these cars are fairly substantial investments. You're talking 80 to into the six figures relatively quickly if you get that new Model S that everyone seems so excited about, and that people are terrified. If you're worried, so that's a significant investment in the long-term future of the company. You want them to be around at least 5 years, probably 10 to service that car and maintain it and all that fun stuff. And you don't really have those questions when you go out and buy a Ford and other. You think they're going to be around in 5 or 10 years. But in Tesla, perhaps you're not too enthusiastic about that prospect. So maybe they should offer as a package, or maybe someone like you, Uncle Mike, a financial advisor out there could say, hey, looking to buy a new Tesla? Let me construct your additional package, your Tesla lifetime protection package. So maybe we won't go lifetime. Maybe we'll just go a couple of years out. Maybe we'll say Jan 2017. They go out and pick up perhaps, because if they're worried about Tesla going to zero, well, pick up some, Leap 150 puts, something along those lines. That's a nice, I guess you can probably do with a one lot at that point, right? Because you only need 100 shares or so to really offset a lot of your car's value. And so you can talk about a $2,400 package right there. Or perhaps maybe...
Now, see, it's that type of thinking that made America great. That's how I need to go out and advertise myself. I'll co-brand myself with Tesla, to where if you're concerned about the company going bankrupt, hey, go see Uncle Mike to buy some puts on the company.
Yeah, they have option package quite literally for everything else: sound, safety, add the lifetime worry-free, or at least in this case, 2-year worry-free protection. Kind of like an extended warranty. There you go. You're selling extended warranty, sir.
I love it.
And if they want to get the cheap extended warranty, tell them get like the Jan 2017 par puts. So the company gets cut in half, then it gets cut down to zero. You're still doing all right. You're still making your money. And of course, it's only about $800. So there you go. Then people are happy, and then they finance their car as they've done better than their car. And of course, if the company goes away, who cares? You finance the cost of that car, and you can have someone else fix it for you.
I love it, because then by doing that, and think about it, if let's say you spend in theory $100,000 on a car, that's nothing in terms of an add-on. You have all those different options for adding on various features to the car. Why not add on the company bankruptcy protection plan? I can do like what the natural gas companies do, to where I remember a couple of years back, they came out with this thing to where if you wanted to lock in your rates on your natural gas bill for the whole winter, you could if you paid a little bit extra. And so I did the math on determining what the natural gas puts were in existence. And now, granted, it wouldn't have worked for me personally because, well, if you look at natural gas futures contracts, you're going to be the size of the contract is going to be significantly greater than what the home natural gas cost would be. But I just looked at the math and tried to scale it to see how much money the natural gas company was making on this. And they're basically, if they're getting the scale that they need, they basically were buying puts and then selling them to people for like 3 to 5 times what the actual protection would be.
There you go. I think you could call up some local, they don't really have dealers, but they have some stores. You can call up their local store and say, hey, let me work with you on the Tesla option protection package. What do you think?
I love it.
Hey, if people are willing to spend a couple of grand on shiny chrome trim, they'll want to spend a couple of grand to make sure that company is around. And if not, at the very least, they're getting paid for it, right?
Why not? I love it.
There we go. That's what the show exists for, Uncle Mike, is to find new and unique marketing initiatives for you, sir.
That would be the most unique one that I'm embarrassed that I'm not the one that thought of that. That one is just genius.
Well, there you
Pure
go.
Genius.
My invoice will be in the mail forthwith, sir. Of course, speaking of hedging risks and energy efficiency and all that fun stuff, today was perhaps a day maybe you want to think more about leaning towards an electric type car. Oil, of course, gapping up. I think it closed about 6% up on the day. I know intraday is up about 5.5% over there on the May delivery for the WTI contracts. The May Brent up a little bit less, about 5%. I think they closed both closer to 6 on the day. A lot of that coming from Saudi, of course, Saudi Arabia saying that they're going to raise prices yet again, mostly in the Asian markets, but still that's showing a bit of a sign that perhaps price increases could be coming. Of course, we also saw the agreement to curb Iran's nuclear program. Won't have Iran turn around and immediately just dump a glut of oil on the marketplace. So the combination of those few things seemed to bump up, and well, it didn't seem to, it definitely did, but certainly it seemed they seemed to combine to move us a wee bit north. Again, like I was saying, a bullish day across the board, including out there in good old crude. Uncle Mike, how's it going on your everlasting downside put selling program out there in XLE? How's that looking for you?
Well, I guess I really should have sold that teeny premium at the 35 level on XLE like we were joking about. I should have done it. I'd be a whole penny ahead now. No, I still like it, crude. I think that with what's going on today I think that's kind of the first sign of some things that are going to be happening going forward. The craziness in the Middle East, it's been happening since the beginning of time. It's probably going to be happening until the end of time. But the fact that OPEC wants to kind of give a little bit in terms of the price war with which they're having with the fracking companies in the U.S. kind of makes me think that maybe we might see a little bit of upside in oil.
Since we're talking about upside in oil, it seems like the perfect opportunity to segue into our old friend, the Odd Block. Uncle Mike, I hope you got your unusual activity pants on because you're going to be joining me for some fun analysis in the old Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody, you know what that funky tune means. It's time once again for the Odd Block, the portion of the show we break down the weird, the wild, the wondrous, the whimsical paper that is lighting up the old options market. Since we're talking oil, since we're talking upside, it just seems right to kick things off with some activity we saw out here in the Market Vectors Oil Services ETF, aka OIH, closing today right around 35.5 or so, up about $1.25 or nearly 4%. On the day. It's a name that does fairly decent volume, certainly compared to a lot of the names we profile here in this segment. This does about 22,000 contracts a day, so well over 10x of our usual names here. Sometimes 100x of some of our usual names we profile here on the old Odd Block. And today doing even more than that, doing 55,000, so over 2x. They're already very inflated volume out there, so a lot of paper today, and a decent amount of that coming, at least when we first started profiling it, about 15,000 of those 55,000 contracts coming in one, not up and out so much as just straight on out roll. It was the APE May 35 call spread that caught our eye. When we first started profiling this on the site this morning, it was going up 10,000 by 5,000 times, 10,000 on the April 35 strike, paper selling, and then, of course, going on out to the May 35 strike where paper was buying. Let's see, let's pull it up here to get the exact strike. So many weeklies in the way, Uncle Mike. But, of course, as the day went on, that volume changed. It seemed to be going up on a 1-by-2 ratio, but as the day went on, the volume just continued to pile in to the tune of a little over 13,000 going up on the May 35s. and a total of 14,000 of the April 35. So more of a 1-by-1 trade than we initially profiled it going up as a 1-by-2. Seems like some of these prints went up late. That often happens with these big blocks. Again, that's on some size open interest in April, about 30,000 or so contracts, and taking off about 14,000 of those, rolling those out to May, where the open interest is just 1,900 contracts. If that is the case, if our friend is indeed rolling and he is doing it 1-to-1, then he's got a lot more to go, to the tune of, and maybe another essentially what we saw going up today. This initial kind, we talked about the 10,000 by 5,000, went up in about 2 blocks. And again, this is what you usually see when you're rolling here. You got a position that's going up. It's doing all right for him. I mean, the April 35s are in the money now, so I'm sure he's happy about that. But also, time to expiration is kind of ticking down. He wants a little bit more exposure, a little bit more time for the upside. And he did at least the initial 1-by-2, which again looks like more like 1-by-1, was for 20 cents. Those prices get a little more wonky when you start factoring in the actual size of the ratio, whether it was a ratio, whether it was 1-by-1. These things always get confusing when the prints are out of whack. Either way, though, it's an interesting move here. Uncle Mike, what's your take, A, on our friend still saying, hey, I'm not giving up the ghost. I got a little bit of a move here, certainly past his strike in OIH, but it looks like he wants a little more. And then also, B, what's a scenario where you would think about doing this here? And what's interesting to me, too, is that he maintained his same strike. A lot of times with these, you'll see the old up and out. Well, they'll close it out and they'll roll it to make it kind of a same dollars type trade. They'll use it on a little bit higher strike. Our friend here clearly still maintaining a strong bullish outlook because he's not even adjusting his strike.
Yeah, when you first had mentioned that being a 1-by-2 ratio, that kind of made me think that it was something equivalent of rolling up and out, meaning you would take a higher strike price to where you could do it for possibly even money or possibly even a small credit.
Yeah, the ratio would keep that flat dollars, that's kind of a similar to up and out. You're right.
Yeah, that's kind of what I was thinking at first. But if it is more of like a flat 1-for-1 roll, then I think just what it is that he's thinking, okay, for 60 cents, that's approximately what the difference is in the prices right now as I'm looking at this in the after hours. So it's not an up to the second quote, obviously. But for 60 cents, his thought would be along the lines of, well, I think we got at least another $1.60 of movement or $1 of movement or whatever his number is to where he wanted to expand the time a little bit. I think that maybe the reason why he could have possibly held off on his roll till so late, because this is fairly late in an expiration cycle to be rolling your calls. Perhaps he was hoping that there would be some type of event over Easter weekend. And because a lot of times when there's Middle East things that can happen, a lot of times they do happen over the weekend. So if he was just planning on doing the roll anyway, maybe he wanted to wait for the uncertainty of the 3-day weekend in the hopes that he would get a little bit of a gamma pop this close to expiration. So by doing that, it benefited him to have the extra gamma on the front month calls before he was going to do the actual roll itself. And now that he got his pop like it did today, now it's time to move on and continue in the trade with a little bit longer dated of an option.
One of the most common questions we get here on the network and on the site is, of course, when do I adjust? When do I roll? We like profiling these sometimes. You can see how some people with some money to bring to bear like to do it. And then we can mock them or praise them as the situation merits. Moving on out, a little bit different, not doing the old time roll, but a vertical this time. And not really a roll, but a spread, straight up spread. Coming in good old Outerwall Inc, ticker symbol OUTR. And if you're not really familiar with that name, maybe remember their former name of Coinstar, of course, the parent company of all those retail automated machines like the coin machines you see in your supermarket, or of course probably more famously Redbox and other retail automation solutions. Well, they're now Outerwall Inc, for I guess because their machines are on the outer wall of the machine of the complex. I'm not sure. Again, trading today, or the ticker symbol OUTR, closing today right around 65.84 or so. And this is a name that does not that much volume, about 1,100 contracts a day, doing roughly 4x that today, about 4,400 contracts or so. And what caught our eye, pretty much of that paper, of that 4,400, 4,161 of those coming in one pretty sizable vertical. In particular, well, at least for this name, it was the May 70-80 call spread going up. When we profiled it this morning, 2,000 times in 2 blocks. Not surprising, taking a little bit of facilitation to get a 2,000 lot spread done in a very relatively liquid name like this. Going up for $2, paper buying. Looks like an opening spread because there's no open interest to speak of on either strike, about 400 some odd and about 100 some odd on each of those strikes. So paper coming in, buying about 2,000 of the May 70-80 call spreads, spending $2, I should say, for that privilege. And again, kind of your standard vertical. Looking here, stock trading right here under $66. Our friend obviously needs it to run at least to 72 for this puppy to start making some money for him. Uncle Mike, what's your take on this vertical and in particular the prospect of this isn't really, May sounds long term, but it's really not, it's very close, of a more near term vertical here in Outerwall / Coinstar. I'm looking at a chart here. This thing hasn't been, well, it flirted with 70 back in about a few weeks ago, got into 69 and a quarter or so. So it got close to at least 70, but the 70 is not going to do it for this guy. He needs it to move. So a relatively aggressive upside bet here in Outerwall. What's your take on our friend here? Perhaps being a bit optimistic on the automated retail front.
Yeah, it's definitely a very aggressive play. It's out of the money. If it does move quickly, though, he could end up making some money between 66. It's at just under 66 right now. So he could make some money if it's up at 69 tomorrow from the value of the call spread going up. Because, yes, if he holds it till expiration, he does need to make it to 72. But just to kind of add to that, he is in a 25 delta position right now. So apparently he sees something to where he wants his 25 deltas on the table. And he feels that's the best way with which to do it. What I would have probably done if this, unless he's intending for this to go to the mid 70s, what I would have probably done is just take less of the values and just bought more of the 65 or 70 calls. I think that would probably make more sense to me personally if I were trying to just get something out of like a 1 or 2 week pop on this one. So you never know what they're doing on the other side of it, but if they are looking to hold till mid-May or whenever till the May expiration cycle, then maybe they want the ability to make money off it going to the mid 70s because that's their projection. But if they are looking to make money off of it, just gaining like $4 or $5 in a week or so, then I think just buying a long option would have been a better way to go.
Yeah, and this kind of touches on a listener mail we might have a chance to get to a little bit later, if not today, certainly on Thursday's show, regarding when do you want to load up on those out-of-the-money calls. Another frequent question that we get here on the program. But there are a lot of different ways to skin this cat. I kind of concur with you, Uncle Mike. I'm rarely ever in the leap to the upside and spend a bunch of money to do it camp, even though he is doing a vertical in this case, but it still is a bit out of the money. Interesting stuff nonetheless, but before we wrap up the odd block, we got one more to go. We're going to pay a visit to not a frequent offender on the odd block, but they do pop up every now and then, probably because we like their ticker symbol so much. This is Harley-Davidson, a.k.a. HOG, closing today 61.61, a nice even ticker on the day here, and closing up about 1% or so on the day. If you follow HOG, they do about 2,700 contracts a day, doing a decent amount today, doing about 14,000 today. And if you want to find exactly what was going up out here, you got to go out to the front month stuff, actually, pretty near term. Pretty sizable ratio vertical going up out here. When we first started profiling it, it was the April 60, 62 half call spread going up on a ratio about nearly about 1,200 by 2,000 for $1.41. That's the 1-to-1 price, not quoted up on the ratio. As the day went on, the size increased to the tune of about 3,400 on the Ape 60s and about 8,000, sizable ratio on the Ape 62 halves. Again, the initial kind went up in a couple different blocks. Mark spread. The 62 halves were going up through the offer. So that's interesting in and of itself. Usually we see these kinds of aggressive ratios. It's the buy one, sell two, buy one, sell three. Looks like our friends here, if this isn't correct, and I'll have to dig into this a little bit while we're talking about it, but it looks like our friends here were, at least in the initial kind, were gobbling up those 62 halves on a bit of a ratio, in which case we've got about a short 3.5 by 8 ratio coming in, I guess selling the ape 60s and then buying up the 62 halves. Again, takes in a decent credit if Hog hits it to the downside. And this is interesting structure too, because we're trading right around 61.5 right now, right kind of in the middle of those two strikes, and he's kind of ringed it with a pretty interesting one. So this thing, if it gaps down, looks pretty good. And if it explodes, it's got to explode. If it explodes to the upside, this one is looking kind of interesting as well. This is, excuse me, all kinds of weird, not just for the ratio, but the fact that we're seeing this going into earnings. This is an earnings month, April. We have earnings expected actually confirmed on the 21st. This is an earnings play as well. I'm trying to remember the last time we saw a kind of a short ratio type back spread like this going into an earnings month. This is pretty interesting stuff. Uncle Mike, what's your take on this spread itself, and what's the time frame? I'm trying to think of when that's not a bad trade. I'm trying to think of a scenario where I would want to go into an earnings with this kind of funky short ratio back spread on.
Well, I think this, as he's looking at it, there has to be some stock involved in some way of already it being held. Sometimes the big money isn't always the smart money, but whenever anyone says to me the word ratio spread, the first concern that always comes to mind with me is along the lines of, are they concerned or do they understand that you can be too right on these? Because with a ratio spread, what can happen is you put on a 1x2 and you think, okay, XYZ stock's at 45 and the 45 call is $2, the 50 call is $1. So I'm going to make it a free spread and sell two of the 50s and buy one of the 45s. So that way, if it goes down, mathematically impossible to lose. But if it goes up, hey, who ever heard of being too right? Well, you can be. So the first concern I always have whenever you're looking at a ratio is understand the risk that you can be too right on something like this. If this is approximately, I'm just looking at the numbers on this, let's just make this a 3-to-1 ratio to even it out. If that's the case, then it's close to an even money spread, meaning that the cost of the 60 call is going to be about the cost of 3 of the 62 half calls. So it kind of could be. If it stays the same, you're in pretty good shape. If it goes down, you're fine. It's not going to be that much of a risk. But if it goes up, you're going to be hurting. If there's no stock involved with this, what can happen on it is if this does stay the exact same over the course of between now and expiration, meaning that Hog is right at 61.61, then the value of this, the fact that you're getting something for nothing, meaning the 60 call is financed by the 2.5 to 3 62.50 calls, it can be of benefit to you. So I think that as what this would be is kind of a complicated negative short straddle, if that made any sense at all.
Made about as much sense as the trade itself, sir. You're right. It's an interesting one. When I look at it straight up, I kind of get the feeling as well that it probably is some stock lurking somewhere. We didn't find any stock going up today, listeners. This is probably an existing position they may very well have on here. And then looking at this, saying if it drops in the near term, I can get some of, maybe hedge some or all of that stock deltas. I'm not sure what ratio he's doing it on versus the stock. At least take some of that sting out of the downside. And hey, if it pops, well, I'm doing all right as well. It's an interesting one as well. Hey, write in, let us know what you think of this type of trade and when you would like to use this kind of short ratio / back spread. I hate to use those back spread, front spread terms because they confuse the hell out of everybody. I just like to go with ratio usually because people usually know what the hell you're talking about, except in this rare scenario when it's actually kind of the old reverse ratio. 9 times out of 10 when you're talking ratios, it's buy 1, sell 2, buy 1, sell 3. That's pretty much the way it goes. But once in a while we get some interesting ones, hence the name of the segment, the Odd Block. That's all we got time we have for some unusual activity today. Again, listeners, we'd love to hear from you guys, so let us know what your ideas are for these types of trades we're talking about. Meanwhile, we're going to keep on rolling. It's Monday. That means it's time for some strategery. That means it's time for the strategy block.
It's time to dispense options, wit, wisdom, and education. It's time for the Strategy Block.
All right, everybody, you know that music means it's time for Uncle Mike. We did do a little bit of strategery in the old Odd Block today. I like to mix it up for you every now and then on the show, but of course, this is the dedicated portion of strategery on said program, the portion of the program where Uncle Mike grabs his smoking jacket and his stone tablets from upon the walls and sits down by a nice roaring fire, even though that's kind of unnecessary in scenic and lovely St. Charles, where it's always a nice 72 degrees, grabs the old bubble pipe and proceeds to dispense some options, wit, and or wisdom. Uncle Mike, earlier in the show, I've already dispensed some wisdom to you in the form of your ingenious new Tesla option protection package plans, which you shall proceed with forthwith. So let's return the favor for our listeners. Let's dispense some wisdom to them. What do you have in store for us today, sir?
Oh, today I want to go through when it's okay to take profits early. There is an old debate that goes on. Taking profits too early is foolish because over time you end up killing all of your gains. There's the other side of that argument is that you never go broke taking a profit. My opinion on that is that you need to kind of have both sides of it, but don't be a perfectionist trader. Let me give you an example. A typical strategy of what I like to do, or what I've been doing at least over the course of the Q1 of 2015, selling put spreads on dips for SPY. The reason with which I like to do that, we've talked about on the show. On the dip, volatility typically goes higher, so you can sell a put spread a little bit further distance from the current strike price. And if the market does come back, then you're in a great spot at a relatively low risk trade. Now, there's obviously ways with which you need to manage risk for it, when to roll, when to get out. I've beaten that to death on the strategy block over the course of the last few months, so I'm not going to get into that now. But I do want to give you a trade that I did last week. It was a trade that was over the course of one day, and why I got out of it when I did, why I took profits early. On April Fool's Day, on Wednesday, markets opened down. There was always that mystery as to, well, why were the markets down in futures so much overnight? No one could figure out why. But nonetheless, it really didn't matter to me. Markets were down a pretty decent amount in the first hour of trading that day. So what I did was I sold the April week 2 200 195 put spread on SPY. SPY, I believe, was trading at around 204, 205, something along those lines. I forget the exact number, but either way, it was far enough away to where I felt comfortable taking on that risk. Ended up getting 46 cents for the put spread. Now, typically, I like to get 50 cents for it, but for 4 pennies, I figured, well, I can handle not getting the 4 pennies at this one particular time. Now, what happens with that is typically what I like to do is get it to the point where, oversimplified, get in at 50 cents, get out at 10 cents if the market goes up in value, or if enough time decay does its thing. But in this case, on April 2nd, markets rallied, and it rallied a little bit on April 1st, shortly after we got into the put spread. But on April 2nd is the key day for this, is when markets rallied. And so I wanted to get out of that put spread for the weekend if possible. If not, I would have been fine holding on over the weekend because of how far the distance was between the current price of the market as compared to where the short strike was. But I was given an opportunity by the market. I could get out of that put spread for 20 cents. And instead of waiting for it to go down to 10 cents or 8 cents or whatever to get my total profit on it, I decided to get out of it for 20 cents. The reason is because of the fact that it was one day. And if you can get out in one day for half of your profit over the course of 1 week, a lot of times I like to do that, especially if it's right before a long weekend. Now, with that, we had a little bit of a pop in the marketplace. So I guess I shouldn't say a lot of times I like to do it. A lot of times I like to do it if it's before a weekend. if this would have been on just a regular Tuesday afternoon or something along those lines to where we didn't have the weekend coming up, I probably would have stayed in the trade. However, going into a 3-day weekend where we have 3 days of uncertainty, 3 days that I'm not able to touch my accounts for myself or my clients, I figured that I'm in more control if I'm in cash. So I left a little bit over a dime on the table for profit, and here was why. The question that I ask myself, and you should too, is if you're ever debating over whether you should get out of a trade or not, if you were flat going into today, would you get into this exact trade that you're in right now if you were flat? And if the answer is no, then I would say 99% of the time you need to just get out of the trade. And that was just a rule that I had going into April 2nd. I was thinking, okay, would I put on this put spread right now for a 20-cent credit? And the answer was a very bold, resounding no. So I'm like, well, okay, I got to get out of this then. Now, with that being said, the other good part about that is that I didn't have to worry about anything with that put spread over the weekend. I was sitting in cash. Now, of course, early today, if you watch the futures in the pre-market, markets were down, and markets were down, or they kind of got a little bit better until we got the comments from the Fed about the dovishness of where the Fed is right now, and then markets rallied. But the point is that should you take profits early, or should you be disciplined and try and squeeze every penny out of the market? My opinion on that is that it depends on the situation. Have your rules as to when you're going to break one of those rules or the other one. So in other words, me personally, I like to be disciplined and try and squeeze every penny that I can to get my goal, not squeezing any penny out to let spreads and short options expire worthless. I think that's foolish. But I try to not get out of things too early because I do think that eats into profits over time. However, if it is to err on the side of caution, if it is to avoid some type of news event, if it is to avoid a 3-day weekend, then at that stage, I would take profits early. And I think that can be applied to any type of option strategy that there is, not just verticals. And that is the strategy block for today.
Well said, sir. I find that to be a decent rule of thumb, too. People ask me all the time, when do you want to adjust or get out of things? I often say the same thing. I say, would you put it on here? That's a good starting place for your analysis. And if the answer is no or resounding no, then get the hell out of it, or take it off, adjust it, whatever you want to do, whatever the thing is you're considering. But if you can't even pass that very simple litmus test with your position, then it's probably time to adjust it or close it out and move on to the next thing. Speaking of moving on, we didn't get a chance. There was no show last Thursday. I know that's when we usually like to do some listener mail. So I'll make sure we try to get at least a couple of you, at least one or two of you in on the show today. So without further ado, let's dive on into a quick mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, everybody, welcome to the Mail Block. As the name implies, this is the portion of the show where you guys get to join us here on the old All-Star panel, send us your questions, your comments. No shortage of ways for you guys to do just that, including via the mothership, theoptionsinsider.com. Leave a comment in the show notes. Use the website feedback form. A lot of you guys like to use that. Find us on email, questions at theoptionsinsider.com, via social media, twitter.com/options, facebook.com/theoptionsinsider, or, of course, stock twits. We are just Options Insider. So, again, no shortage of ways for you guys to send in your questions or comments. Kicking things off here with, looks like NYSE Trader writing in, says, is it possible for hedge funds to press on options of illiquid stocks to manipulate prices? Can they do that? Interesting question, Mr. NYSE. So let's in this hypothetical scenario, let's imagine an illiquid stock. So stock doesn't trade very much by definition. Now imagine the options on that stock. They also, by definition, will not trade very much because if the underlying is liquid, guess what? The options aren't going to be liquid. So you can imagine how wide the spreads are going to be in the underlying. Now translate that into the actual options, because you have months in series going out months, if not years, calls and puts on every strike. The farther out, the less liquid you get. And of course, the wider those types of spreads get. So all of these products out there are going to be very illiquid. They're going to be very wide, very difficult to trade. And this kind of, all this question, I think, stems from this supposition that's pretty widely held out there, that market makers, liquidity providers can create liquidity where none exists for themselves. And I'm the first person here to tell you that they cannot. If they can't hedge in the stock, they can't replicate that liquidity for you in the options. And so they're going to price the options where they can get their hedges off in the stock. So in this case, you're going to have a lot of options that are going to be very wide. So if you do want to come in and just get a bunch of, let's say you want to get a bunch of short deltas off in this particular underlying, and you can't do it in the stock, or you don't want to do it in the stock because you're going to run the stock. So let's say you start blasting away at in the money or at the money calls in this name. Well, guess what's going to happen? First off, you're going to be selling them, if they're in the money, you're going to be selling them below where you have to hit the bid in this name because it's a liquid, or get very close to it. You're not going to be able to just put in a mid-market offer, have someone come in and step in and fill you, particularly if you're going to be doing any size. So you're going to be hitting bids, and guess where those in the money calls and at the money even are going to be? They're going to be probably close to, or synthetically below, where you could sell the stock in the marketplace, because that's a bid offer spread. It's going to be wide. And the more you keep crushing those, the more that bid's going to drop, the worse your fills are going to be. Same thing goes for the synthetics we're always talking about, combos. Let's say you want to get in and get synthetically short the stock, sell, call, buy, put on this same strike. Well, bid-ask spread on the call, bid-ask spread on the put. So you got those two together now. Multiply that spread by 2. That's how wide that market for that combo is going to be. And so imagine you're going to try to middle market that. No one's going to step up on a combo to fill you unless the stock is ticking and they can try to pick you off on the underlying. And so we used to do this all the time out in the SPX. People would come in trying to do quote combos and trying to pick us off on the futures. And market makers aren't stupid. They know where the underlying is trading. So even if you're doing that, you're going to be hitting bids on the calls. You're going to be close to it. You're going to be close to or lifting offers on the puts. You're going to be paying just a tremendous amount to do this. So I would say in this scenario, that's your main goal, to try to somehow crush the stock through the options. I think the market makers and the people doing the stock are going to be laughing all the way to the bank, because they'll say, sure, do it. Here you go, wider, wider, wider. Now, of course, if you have infinite amount of money, that could be dangerous to them after a while because it's a liquid name. But in the near term, for most reasonable amount of paper, they're going to charge you so much to do it that it's going to be a very expensive proposition for that hedge fund to do that. And then, of course, getting out of that, forget about it. It's going to be the exact same thing in reverse. So I don't see a lot of scenarios where this is an effective way to really manipulate the stock. You can get better fills doing the stock directly usually, and certainly not get taken to the cleaners on these bid-ask spreads. What's your take on this kind of conspiracy theory, Uncle Mike, that the hedge funds can come in and just blast away on the options or buy them, whatever the case may be, and just drive the stock wild?
You're right. In terms of the bottom line is, can you create liquidity where none exists already? And I don't see any way with which it could be done. The only way with which I could see it done wouldn't necessarily be through that of a hedge fund, but it would be through maybe an unscrupulous newsletter, meaning all of a sudden they go out and tell all their people, it just the old the front running thing, to where they go out and they buy a bunch of calls, and then they tell their newsletter people, yeah, go ahead and buy all these calls, and then the value of the call goes up, and then maybe they're on the other side of the trade in some way, shape, or form, and maybe they have the stock involved, or there's ways in which you can do it, but not legally or ethically, so to speak. And I think it would just have to be involved not with a hedge fund per se, but more with an unscrupulous newsletter.
That's pretty much just par for the course with newsletters. In fact, when we're profiling unusual activity on this show or some of our other shows or on the website, one of the hallmarks we look for a newsletter trade is that first block, that first sizable block. Call it the front-running block, if you will, where that newsletter author is front-running all of his customers. And then, of course, he turns around. They all bid it up dutifully after the fact, or crush it, whatever the case may be. And he's a happy camper usually. So in that case, yeah, maybe you're right. But that's more of a scam against their own subscribers and clients than it is against manipulating the stock. But still, you're right. There are interesting things you can do with options. I just don't see people coming in and wearing the tinfoil hats and saying the hedge funds are going to somehow, or whatever it may be, market makers, whoever, are going to use the options to crush and somehow manufacture liquidity in this illiquid name in the options that doesn't exist in the stocks. It's got to be there to trade it. And if it's not, you're not going to manufacture it. And if you're going to try to get it off, it's going to cost you a substantial amount of money. If you're curious about this, go look at pick any liquid name that has options on it and go look at some of the spreads out there and start calculating in your head how much it would cost you to do combos, to do synthetics, to do in the money calls, whatever the case may be, and just see how much it's going to cost you. And then say, well, I don't know if that's the most cost effective way to try to get the stock off. Probably not. All right, that's unfortunately Uncle Mike and I have gassed on pretty well. We're getting towards the end of the show. So that's all the time we have for the mail blog. And now it's time to dive right on into our final segment, Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
Well, of course, Around the Block, the portion of the show where we tell you what we're watching for the week to come, and it's not really kicking off earnings season yet until later this week. We got Alcoa, usually kicks it off, and that's on Wednesday. So that's when things really start heating up from an earnings perspective. I know a lot of you really like to trade the earnings, so we'll be dovetailing. It seems like we just finished up earnings season already. We're back into it again, but c'est la vie. So some names kicking off on Wednesday with one of your favorites, Uncle Mike, Family Dollar, then getting into the RAD, the Rite Aid, and Walgreens on Thursday, and it's off to the races from there. We also saw last week, of course, that jobs report and the resulting comments from the Fed. We'll see how that plays out this week. In addition to earnings and the ever ongoing Fed debates, what else are you keeping an eye on this week, Uncle Mike?
The shiny stuff, gold, and the slippery stuff, oil. I think both of those are going to make some very interesting moves this week. I'll give my 50% guarantee as per usual as to which way, but everyone knows who listens to me on this show, I am bullish on those over a longer period. But I think with the gap ups today in oil and gold, I think we could have some interesting movement this week. So I am excited, to say the least, with those two. In the world of stocks, we're still to the point to where we're just diddling around, being slightly up on the year. And I think I've said it before on the show, and the old trader saying, buy the dump, sell the hump, don't diddle in the middle. Right now you're diddling in the middle. So what I'd like to see in stocks is I'd like to actually see the market do something. But in the meantime, if we do just a little something, I'll sell something in one way, just don't know where as of yet. So that's kind of what I'm watching right now.
Thank you for that, Uncle Mike. And that's about all the time we have, so we need to wrap it up there. But before we go, as always, really quickly, Uncle Mike, tell us what's coming down the pike. What can we look forward to from the land of RCM Wealth Advisor / RCM Alternatives?
The RCM season, IRA season is coming to a close, folks. So make sure that if you have any questions on IRA contributions or anything along the lines of IRAs, give me a call sooner rather than later at 312-212-3531 or send me an email at mtusaw@rcmfs.com.
I like it. Maybe someday RCM season, sir. We're not there yet, but maybe someday.
Maybe.
All right. Thank you for that, Uncle Mike. And on behalf of Mr. Uncle Mike, as well as the Rock Lobster and the Greasy Meatball, couldn't make it, and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show and for sending in such great questions. Don't worry. We'll get to a lot more of them on Thursday. I know a lot of you guys are writing in. We love to hear from you, so keep sending them in. And we'll see you next time right here on the Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.